All right, so we are diving into investing today, and we're taking a look at this YouTube video by Mark Tilbury, who calls himself a millionaire investor.
Oh, wow.
And he tests out investing $100 in 5 different ways over 4 years.
Okay.
Now, before we get started, remember, this isn't financial advice.
Yeah.
Think of it as a peek behind the curtain to see what worked and what didn't.
Uh-huh.
You know what we can learn from his experiment?
It's a really interesting way to look at real-world results,
I suppose.
going beyond the theory of
Yeah.
investing.
So Tilbury starts with a classic approach,
Mm-hmm.
individual stocks,
Okay.
to spice things up.
Yeah.
He actually chose his stocks by throwing darts at a board
What?
with company names.
No way.
Can you believe that?
That's amazing. I love that.
He landed on Samsung.
Wow.
It's a fun way to illustrate a point, right?
It is.
Picking individual stocks without a strategy can be a gamble.
It really can.
And in this case, the gamble didn't pay off,
Oh.
even with dividends. Tilbury ended up with a 32.3% loss over 4 years.
Ouch.
Yeah, ouch is right.
That's the risk you run with individual stocks.
Yeah.
High reward, high risk.
Exactly.
If his dart had landed on, say, Apple,
Mm-hmm.
he'd be looking at 70% gain.
Wow.
But it could have just as easily been a company that barely broke even,
Yeah.
like NVIDIA in his experiment.
Oh, interesting.
Yeah.
So luck is not a sustainable strategy.
No, not at all.
Tilbury really emphasizes that you need to understand a company's fundamentals before investing.
Yeah.
Their financials, their leadership, their overall market position.
That's key.
He's a long-term investor, though,
Okay.
aiming to hold stocks for at least 2 years,
Mm-hmm.
ideally up to 10.
I think that long-term view is really important.
Yeah.
Short-term market fluctuations
Oh, yeah.
can be scary,
Yeah.
but over time, a well-chosen stock can yield some pretty significant growth.
Right.
It's about riding those waves and focusing on the bigger picture.
That makes a lot of sense.
Yeah.
It does make you wonder, though.
What's that?
Would you be comfortable with that level of risk
Right.
for a potentially big payoff?
I think it really comes down to your individual risk tolerance.
Yeah.
Some people love that volatility.
Uh-huh.
Others prefer a much steadier approach.
Yeah, I can see that.
Ah.
Let's move on to something that might feel a little bit less like riding a roller coaster.
Okay. What's that?
Real estate investment trusts,
REITs.
or REITs.
Okay.
Tilbury explains this in a really simple way.
How so?
Imagine pooling money with some friends
Mm-hmm.
to buy a rental property
Yeah.
and then splitting the profits.
That's a great analogy.
It is a really good analogy.
It makes it very easy to understand.
Yeah. REITs open up real estate investing to those who don't have the capital to buy an entire property
Exactly.
on their own.
Yep.
So how did Tilbury's REIT investment perform?
Yeah. How do you do?
Well, he actually experienced a small loss,
Okay.
just 1.41%.
All right.
But factoring in the $1.93 he earned in dividends, his overall return was 10.52%.
It's not bad.
Not too shabby.
Not bad.
Right.
I think it's worth noting this particular REIT probably underperformed
Okay.
because it was focused on commercial real estate,
Ah.
a sector that really struggled during the pandemic.
Yeah, that makes sense.
So even with that specific case in mind,
Right.
it shows the potential for stable income with REITs.
Yeah, you're right. That stability comes from those long-term leases.
Right.
Businesses typically sign.
Exactly.
And REITs must distribute 90% of their profits to investors.
Oh, wow.
So as long as the REIT is doing well, you are practically guaranteed some passive income.
That's a huge draw for a lot of people.
Yeah.
It's a way to tap into real estate without all the headaches of being a landlord.
Yeah, without the hassle.
But of course,
Mhm.
research is still key.
Right.
You need to understand the types of properties
Uh-huh.
that the REIT invests in and their overall strategy.
Makes sense.
For example,
Yeah.
some REITs specialize in residential properties,
Okay.
while others might focus on specific sectors, like healthcare, their
Interesting.
infrastructure.
So REITs can be a good way to diversify your portfolio
Mm-hmm.
and dip your toes into real estate.
Yeah.
But it's not just set it and forget it.
No.
Research is your best friend.
Research is key.
Now buckle up, because this next one is where things get really interesting.
Oh, I know where we're going here.
Cryptocurrency.
Cryptocurrency.
It's been making headlines for years,
Oh, yeah?
creating fortunes for some, leaving others scratching their heads.
For sure.
Tilbury describes it as digital money,
Okay.
free from the control of banks or governments,
Right. Yeah.
secured by blockchain technology.
It really does sound futuristic.
Doesn't it?
It does.
It's a disruptive force in the financial world.
Yeah.
We've all heard the stories about Bitcoin's rise.
Yeah.
But Tilbury emphasizes a crucial point here.
What's that?
It's a blend of investment
Mm-hmm.
and speculation,
Okay.
not for the faint of heart.
No.
No, remember that roller coaster we talked about with stocks?
Mm-hmm. Right.
Crypto can feel even more extreme.
Like you're launching into space.
Exactly.
And the rocket might not make it.
Oh my goodness.
Yeah.
Tilbury's personal approach is to stick with Bitcoin and Ethereum.
Oh, okay.
He considers them the more established players in the crypto space.
Kind of like the blue chips of the crypto world.
Exactly, makes sense.
Yeah.
He also breaks down some of the basics,
Okay.
like using wallets to store your crypto,
Right.
exchanges for buying and selling,
Mm-hmm.
and this concept of tokenomics.
Oh, yeah. Tokenomics.
What do you mean?
Essentially, it boils down to understanding the supply and demand
Okay.
dynamics of a specific coin.
All right.
So let's say Bitcoin, for example.
Okay.
Limited supply.
Yeah.
21 million coins.
Mm-hmm.
Combined with increasing demand.
Yeah.
That's a key factor driving its value.
So it's like a digital version of gold where scarcity plays a big role.
Kind of, yeah.
Tilbury also mentions passive income opportunities within crypto, things like staking and yield farming.
Okay. These can be tempting, right?
Yeah.
Offering those high potential returns.
Yeah.
But they come with equally high risks.
Right. If the coin's value plummets or the platform gets hacked,
Exactly.
all those earnings can disappear.
Oh, God.
It's a high-stakes game.
It really is.
All right, drum roll, please.
Okay, here we go.
Tilbury turned his $100 in Bitcoin into
wow.
$652.
Huge return.
Huge return, but I'm guessing that's not typical.
No, those kinds of returns are pretty exceptional.
Okay.
Especially considering this was during Bitcoin's peak.
Yeah.
It's really important to remember past performance doesn't guarantee future results.
Of course.
Right.
So crypto, exciting, potentially lucrative,
Yeah.
but not for the risk averse.
No.
It's like that friend who's always up for an adventure,
Yes.
but sometimes that adventure involves a few too many unexpected twists and turns.
I like that analogy.
So let's shift gears now to something a bit more grounded. You're talking about gold, right?
Gold, the classic safe haven asset.
It's been around for centuries.
Exactly.
Tilbury positions it as the go-to investment during times of uncertainty,
Like what?
economic turmoil,
Okay.
inflation,
Again.
things like that.
You know what's really intriguing about gold?
What?
Is its historical significance.
Oh, yeah.
I mean, it's been a store of value
Uh,
for millennia.
Yeah.
That inherent value offers a sense of security,
Right.
especially during those unstable periods.
And there are a couple of ways to invest in gold.
Mm-hmm.
You can go for physical gold, like bars or coins, or you can opt for gold ETFs,
Okay.
which are funds that you can buy and sell easily.
Yeah.
Tilbury prefers coins.
Does he?
Specifically, he actually cautions against jewelry as an investment.
Why is that?
Well, because jewelry includes a significant markup
Right.
for craftsmanship,
Yeah, that makes sense.
so it dilutes its pure investment value.
Right.
Physical gold also has that unique advantage of being transportable.
Oh, yeah.
It allows for discrete movement of wealth,
Interesting.
of course, with its own risks.
Of course.
Now, Tilbury used a gold ETF for his experiment
Okay.
and achieved a 40.1% return.
Solid.
Not as flashy as Bitcoin,
Right.
but still a very steady gain.
Steady growth.
Gold may not offer that rapid growth,
Mm-hmm.
but it can provide stability and a hedge against inflation,
Exactly.
which is particularly important
Yeah.
during those times of economic uncertainty.
Yeah, that makes sense.
What about something a bit more diversified?
All right, what do you have in mind?
Well, index funds.
Index.
Imagine owning a tiny piece of Apple, Microsoft,
Yeah.
Amazon all at once.
Wow.
That's the power of index funds.
It really is like owning a slice of the entire market.
Exactly.
Right.
Index funds offer instant diversification
Yes.
by tracking a specific market index,
Like the S&P 500.
like the S&P 500.
Yeah.
So instead of trying to pick individual winners, you're essentially betting on the overall growth
Right.
of the market.
And you're not putting all your eggs in one basket.
No, you're not.
You're spreading the risk
Yeah.
and riding that wave of the market's overall performance.
That's the beauty of index funds.
It is.
They're simple,
Mhm.
they're passive,
Yeah.
and historically,
Mhm.
they've delivered consistent returns over the long term.
Absolutely.
You don't need to be a stock market guru to benefit from that growth potential.
Nope.
And Tilbury's a big fan.
We see.
His S&P 500 index fund yielded a very respectable 57% return.
Wow, that's great.
Not bad at all for a set-it-and-forget-it approach.
Not bad at all.
Index funds are often considered a great starting point
Oh, yeah.
for new investors.
Yeah.
offering a relatively low-risk way to participate in the stock market.
Exactly.
Okay, so we've covered a lot of ground here,
We have.
from the highs and lows of individual stocks to the steady hand of gold
Uh-huh.
and the effortless diversification of index funds.
Yep.
Tilbury's experiment has given us some really fascinating insights
Yeah.
into the world of investing.
But I think this is just the beginning of our deep dive.
Okay.
We've explored the potential returns, the risks,
Mm-hmm.
but there's another crucial layer to consider,
Right.
one that Tilbury didn't directly address.
Oh, a cliffhanger.
We'll delve into that in part 2.
Yeah.
But for now, I want you to think about this.
All right, I'm ready.
Tilbury really focused on the financial outcomes,
Yeah.
the returns and the risks.
Right.
But what about those factors beyond just the numbers?
Like what?
How important are things like sustainability or specific industry support or other personal values
Okay.
when it comes to investing?
All right, so we're going to get into the ethics
A little bit.
of investing next time.
Yeah, the values.
All right, so stay tuned. We'll be back with part 2 of our investing deep dive.
Sounds good.
Okay, so we're back for part 2 of our investing deep dive. And, you left us with a really thought-provoking question at the end of part 1.
Yeah.
What about those factors beyond just the numbers?
Mm-hmm.
Like sustainability,
Right.
supporting specific industries,
Yeah. It's a huge piece that Tilbury's experiment didn't really cover.
Right.
He focused so much on the financial outcomes.
The returns the risks.
Exactly. But there's this whole growing movement in investing that really considers the impact of those investments beyond just profit.
So it's not just about how much money you make,
Right.
but how that money is being made and what impact it's having on the world.
Exactly. It's about aligning your investments with your values
I like
and using your financial power to support businesses and initiatives that are making a positive difference.
So it's like putting your money where your mouth is,
Yeah.
but in a way that actively contributes to causes you believe in.
I like that.
But how do you actually find these investments?
Yeah.
It seems a bit more complex than, picking stocks.
It definitely requires a bit more research.
Yeah.
But it's becoming much more accessible.
Okay.
There are these specialized platforms and resources out there
Okay.
that screen companies and funds based on specific ethical criteria.
Wow.
So they analyze things like a company's environmental impacts, their social responsibility, and corporate governance practices.
So you don't have to spend hours poring over every company's sustainability report
Right.
to figure out if they're actually walking the walk.
Not at all. There are experts who do that for you.
Oh, good.
Yeah, these platforms often provide ratings or scores
Okay.
to make it easier to assess how a company's performing in these key areas.
That's so helpful.
Yeah.
But let's be realistic.
Okay.
Does doing good also mean doing well financially?
Right. Can you actually achieve both strong returns and invest in line with your principles?
It's a good question.
It's something a lot of investors grapple with.
Yeah.
And historically, there was this perception that ethical investments might underperform
Well-
compared to traditional investments.
Mm-hmm.
However, more recent studies have actually shown that's not necessarily true.
Oh, really? So you're saying you don't have to compromise your principles
Not at all.
to achieve your financial goals?
Yeah, in fact, some research even suggests that companies with strong ethical practices might outperform their counterparts in the long run.
That's amazing.
Mm?
Why is that?
Well, there are a couple of factors at play.
Okay.
For one, companies that prioritize ethical practices often have strong brand reputations and really loyal customer bases.
Makes sense.
They're seen as being more forward-thinking, more responsive to societal concerns,
Yeah.
which can lead to stronger customer loyalty and ultimately higher profits.
Just like this virtuous cycle.
Yeah.
People feel good about supporting companies that are doing good.
Right.
And that, in turn, contributes to those companies' success.
Exactly. And there's this growing awareness that companies with these strong ethical practices are often better equipped to handle long-term risks and challenges.
Interesting.
They tend to have more sustainable business models.
Yeah.
So they're more resilient in the face of, say, economic downturns or regulatory changes.
So it's not just about feeling good.
Right.
It's about recognizing that these companies might be better positioned for long-term success
Uh-huh.
because they're actually addressing issues that matter to their customer
Exactly.
and the world.
Yeah.
Let's shift gears a bit
Okay, where are we going?
and explore something that Tilbury only briefly touched on,
What's that?
passive income.
Passive income.
He mentioned staking and yield farming
Yeah.
within cryptocurrency.
Right, right.
Those sounded kind of complex
Yeah,
and honestly a little risky.
they can be.
Are there ways to generate passive income without going into the crazy world of crypto?
Absolutely. There are many avenues for passive income
Okay.
that don't involve the ups and downs of the cryptocurrency market.
Okay, good.
One classic example is dividend-paying stocks.
Right. Tilbury explained that owning stocks that pay dividends means you receive those regular payments from the company,
Exactly.
like sharing in their profits.
It is. It's like a little bonus.
Yeah, just for holding the stock.
Exactly. And the beauty of dividends is that they provide that steady stream of income without you having to sell your investment.
It's like having a little money-making machine working for you in the background.
I like that.
That's awesome.
Uh,
But are all stocks created equal when it comes to dividends?
Not necessarily.
Okay.
Some companies are known for their consistent and generous dividend payments,
Ooh.
while others might pay them out sporadically or not at all.
Interesting.
So it's really important to research a company's dividend history and their payout ratio,
Okay.
which basically tells you how sustainable those payments are.
So research is crucial.
Research is always key.
It seems like that's a recurring theme no matter what approach you're taking
It is.
with investing.
Yeah.
What about real estate? Tilbury touched upon that with REITs.
Right. REITs are one way to go.
Yeah.
You know, pooling money to buy a property and
Right.
share that rental income.
Right.
But you can also invest in rental properties yourself,
Okay.
either individually or with partners.
Mm-hmm.
Of course, this requires more upfront capital,
Yeah.
and you're taking on those responsibilities of property management.
Right.
But it can offer a really significant source of passive income.
It seems like a trade-off.
It is.
More hands-on involvement
Yeah.
for potentially greater control and higher returns.
Yeah. And then there's this whole world of online opportunities for passive income.
Oh, like what?
Things like affiliate marketing,
Okay.
creating and selling online courses, or even writing and selling ebooks.
Wow, the possibilities are endless.
They really are.
So passive income is all about finding ways to make your money work for you,
Exactly.
even while you're sleeping,
Yeah.
enjoying your hobbies, or just living your life.
That's the goal, is creating these multiple streams of income
Right.
that can provide that financial stability and freedom.
Okay, so we've explored this concept of aligning your investments with your values
Right.
and these various paths to passive income.
Uh-huh.
These are all things that Tilbury didn't get too deep into in his video.
Right.
But there's one more piece of the puzzle, right?
There is. We've talked about aligning your investments with your values and generating that passive income.
Right.
But we haven't really touched on the psychological side of investing.
Oh, interesting. Tell me more.
Well, as we've seen, investing can be a bit of an emotional roller coaster.
It can?
There are going to be ups and downs.
Yeah.
And it's easy to get caught up in the hype or the panic
Right.
when the market takes a sudden turn.
Oh, yeah.
You know, successful investing requires more than just knowledge
Uh-huh.
and a solid strategy. It demands emotional intelligence.
So, like, you can have the best information, the
Right.
most well-thought-out plan.
Yeah.
But if you panic and sell everything when the market dips, you're probably going to sabotage your long-term goals.
Exactly. That's why it's so important to understand your own risk tolerance,
Okay.
recognize your emotional triggers,
Yeah.
and develop strategies to manage your emotions when things get a little turbulent.
This is starting to sound a bit like therapy, but for your finances.
You could say that.
Okay.
And just like in therapy, sometimes you need to dig a little deeper
Yeah.
to uncover those underlying beliefs and patterns
Okay.
that might be holding you back.
What kind of emotional baggage are we talking about here?
Well, many people have this fear of losing money,
Of course.
which is understandable.
Right.
But that fear can sometimes lead to bad decisions.
Like what?
Like holding on to those losing investments for too long,
Okay.
hoping they'll rebound, or selling winning investments too early
Right.
out of fear of the market turning.
So fear can really drive a lot of these decisions.
It can, and then you have the opposite problem.
What's that?
FOMO, the fear of missing out, which can lead people to make these impulsive investments based on hype or trends without really doing their research.
We've all seen those stories
Right?
of people pouring their life savings into some meme stock
Yeah.
only to watch it crash and burn.
Yeah. Classic case of emotions overriding logic.
Exactly.
And then there's overconfidence,
Okay.
which can lead people to take on more risk than they can handle,
Okay.
or to think they have this magical ability to predict the market.
Yeah. So we all have our own unique set of emotional quirks
We do.
when it comes to money.
Yeah.
The key is to become aware of those patterns and manage them effectively.
That's the key. Just as Tilbury stressed the importance of researching a company's financials, it's equally important to research your own emotional landscape.
How do you do that?
Well, you can start by simply being more aware of your emotional triggers when it comes to money, Notice how you react to market fluctuations, to financial news, or even just conversations about money.
So pay attention to those gut feelings.
Yeah.
But don't let them completely dictate your actions.
Exactly. It can also be helpful to have like a set of investing principles or guidelines that are aligned with your values and goals. It's kind of like an emotional anchor when the market gets stormy.
I like that analogy.
And remember, investing is a journey. It's not a destination.
Right.
There will be ups and downs.
Yeah.
But the key is to learn from those experiences, adjust your course, and keep moving forward.
This has been such an insightful conversation.
It has.
I've gone way beyond the basics of investing, exploring those ethical considerations, the paths to passive income, and even the psychology of managing money.
But we're not quite finished yet.
Oh.
In part 3, we'll bring all of these threads together and distill them into those key takeaways that you can apply to your own investing journey.
All right, so stay tuned, folks. We're about to level up your investing game even further. All right, so welcome back to the final part of our investing deep dive.
It's been quite the journey so far.
It really has. We've covered everything from individual stocks and REITs to crypto and even that classic gold.
Absolutely. And now it's time to take all that knowledge and distill it down into some key takeaways.
Okay, perfect. So where do we even begin?
Well, I think Tilbury's experiment really highlighted that, there's no one right way to invest. Each method comes with its own, advantages and disadvantages, and those varying levels of risk.
It really comes down to understanding your own risk tolerance.
Right, exactly.
And what your financial goals are.
Right, and how much time and effort are you willing to put into managing those investments?
And we also talked about how investing isn't just about chasing those highest returns, right?
Yeah, that's right.
Socially responsible investing is becoming more and more popular.
It is.
And it's a way to align your investments with your values.
Right.
And contribute to a better world.
It's a powerful idea,
Yeah.
Recognizing that your money can make a difference beyond just those profits.
And we also delved into the world of passive income.
Right.
Right?
Oh, yeah. That's a good one.
All those ways to generate those income streams that work for you while you're off doing other things.
Exactly. Whether it's dividend-paying stocks or rental properties or even those online ventures.
Right. There's so many options out there for creating financial stability.
And freedom.
And of course, one of the most crucial lessons we've learned is that investing is as much about mastering those emotions as it is about mastering the market.
It's so true.
You have to really understand those emotional triggers, right? Manage those feelings of fear and greed.
It's not easy.
And develop those investing principles to guide you through all those ups and downs.
It's like having that strong mental foundation that can weather any storm.
Okay, so with all that in mind, what are some key takeaways our listeners can start using, like right now?
Okay, so first and foremost, I think we need to emphasize starting early.
Yeah, start early.
Even if you can only invest a small amount, like that $100 Tilbury used,
right?
Time is your greatest ally.
Yeah, that compounding really makes a difference over time.
Absolutely.
Yeah.
So don't wait until you have a ton of money.
Right.
To get started, those small, consistent contributions can grow significantly.
Another important point is to diversify.
Right? Oh, diversification, absolutely.
Don't put all your eggs in one basket.
Right. It's like building a strong team. You want a mix of players with different strengths.
Right.
So spreading your investments across different things like stocks, bonds, real estate.
Maybe even a little crypto if you're feeling adventurous.
You can stomach it.
Can really help reduce your overall risk and lead to those more consistent returns.
And, of course, we can't forget about research.
Oh, research always.
It's essential whether you're considering stocks or REITs or anything, really.
Yeah.
Take the time to understand what you're getting yourself into.
Yeah. All right. Read those financial reports.
Yeah.
Analyze those market trends. Learn about the companies or the assets that you're interested in.
Exactly. The more knowledge you have, the better decisions you can make.
Knowledge is power.
For sure.
Especially in the world of investing. And don't be afraid to ask questions.
Yeah, find those trusted sources.
Right.
And never stop learning.
And lastly, patience and discipline are so important.
Oh, absolutely. Essential investing is a marathon, not a sprint.
It's not a get-rich-quick scheme.
No, it's a long game. There will be those moments when you hit a wall.
Yeah, or the market just throws you a curveball.
And in those moments, just remember your goals.
Trust your research and stick to your plan.
Don't let those short-term fluctuations derail you.
So as we wrap up this epic deep dive,
It's been a good one.
what's the one message you want our listeners to take away from this?
I want everyone to know that investing isn't just for the wealthy or, the financial experts.
Yeah.
It's for anyone who wants to take control of their financial future.
I love that.
Create a life of abundance and freedom.
Investing can be a really powerful tool for achieving those dreams.
Right.
Yeah. Whether it's buying a home, traveling the world, or just having that peace of mind.
Yeah.
That comes with financial security.
So remember, approach it with curiosity. Do your research, manage those emotions, and most importantly, enjoy the journey.
That's a wrap on this episode.
It's been fun.
Thanks for joining us. We'll get you next time for another deep dive into a brand new topic.